variable cost. But what is revenue and variable cost? Revenue equal to price of product per unit times sales, while variable cost such as cost of material equals to variable cost per unit times sales. To calculate contribution, revenue must be minus with variable cost. The contribution is so called because this money can contribute towards paying fixed costs. This is example of the calculation. Second, contribution also can be used to decide when to accept a new order or not. Imagine the average price of hotel room is $200 per night, but customer offer to pay $100 per room. Should you accept it? The answer is depends. If the room will be empty, then the business will generate no earnings. But if the hotel accept the offer, then they need to cover the variable costs such as the clean, the replace of soap or shampoo, and also they need to provide breakfast for the consumer. Let's say the variable cost of this hotel is $40 per unit. Then the contribution of selling it to the consumer would be for 100 is $60. The business has $60 only to cover the fixed cost. However, every business will want to know the cost of different products, or regions, or departments. For example, we have a monitoring cost per product, and in regions, we have allocating costs to different branches. And lastly, in departments, we have tracking costs in marketing or HR. So, a business will decide on its cost centers. What is cost centers? Cost centers is a part of the business to which costs are allocated. So now we're moving on to contribution cost. So what is contribution cost? Contribution cost is a method to analyze direct cost to support decision making. So this is the formula for contribution cost from revenue minus direct cost. For example, if product is produced $500,000 revenue and direct cost for $200,000, so contribution cost will be $300,000. And if the indirect cost were $100,000 and the business overall made a profit of $300,000, we can get it from contribution cost minus $100,000 and we can get $200,000.
We have done contribution cost. Now, the next option is absorption cost. Absorption cost is a method where indirect costs are allocated to a different cost center based on specific rules. Okay, I will give you a situation. First, we have indirect costs of $150,000 are allocated using a proportion of revenue. So, in this situation, we use the proportion of revenue as our allocation. Okay, now to calculation part.
In this first situation, where our allocation is revenue. So first we calculate the total revenue, where $500,000 of product A plus $200,000 of product B plus $300,000 of product C is equal to 1 million. So with this 1 million of total revenue, we can calculate the proportion. So with product A, we get 50%, product B is 20%, and lastly, product C is 30%. So with this percentage, we can calculate the allocated indirect cost, where our indirect cost is $150,000. So for product A is $75,000, product B is $30,000, and product C is $45,000. So with this all information, we can calculate the profit by using this formula, where revenue with allocated indirect cost is equal to profit. So product A is $225,000, product B is $20,000, product C is $45,000. So when we combine it, we get $300,000 of profit.
Now, the next part is the overall profit remains $300,000 regardless of the allocation rules. This shows how indirect costs are distributed for reporting purpose. Okay, now we move into the new situations where the staff now our allocations. So, in this case, we use the number of staff as a basis to allocate indirect cost of $150,000. Okay, now for calculation again.
In these new situations, where our allocation is now employee instead of revenue. So the total employee is 20, whereas the product A has 2 employees, product B has 8 employees, and lastly, product C has 10 employees. So we can calculate the proportion using the total employee of 20. So for product A, we got 10%, product B is 40%, and product C is 50%. So with this percentage, we can now calculate the indirect cost. So the same with the first situation, whereas our indirect cost is $150,000, product A is $50,000, product B is $60,000, and product C is $75,000. So with this all information, we can also calculate the profit using the same formula as the first situation. We got the product A is $285,000, product B is now loss, where negative $10,000, and product C is $25,000. So when combine it, we still get $300,000 of profit, the same as the first situation.
Okay, as you see from the calculation, the total profit of $300,000 remains unchanged from the first situations where the revenue is our allocation and the second situations where the staff as our new allocation. From these two situations, the profit is still $300,000. Okay, here's the important note. Changing the allocation rule affects individual product profitability, but does not change the business overall profit. As we can see from the situation 1 and situation 2, the total profit is still $300,000. Okay, next, important note. Manager must avoid making decisions solely on one allocation rule because indirect costs remain even if a product is discontinued. Okay, for this new situation, the product B is discontinued. Because of the calculation we did for the profit, it seems that the product B is now loss of $10,000. Okay, this means product A and C have to absorb $16,000 and the value decreased by $200,000 and its profit of $50,000 is lost. Indirect costs remain at $150,000 but are redistributed between product A and C. Okay, time for calculation again.
Okay, as we know from the situation 2, whereas the product B profit is lost around $10,000. So, what if the product B is continued? So, the product A and C have to absorb the indirect cost of product B, a total of $16,000. So first we calculate the revenue, $500,000 of product A plus $300,000 of product C is equal to $800,000. Now we calculate the direct cost, $200,000 of product A plus $200,000 of product C is equal to $400,000. And direct cost is $150,000. So we calculate the profit, and we got the profit is $250,000. So from before, in situation 2, we got $300,000 of profit. As now, the product B is discontinued, you only got $250,000 profit.
So, this business is worse off financially after discontinuing product B because its $50,000 contribution to direct cost is gone.
When deciding whether to make or buy a product or an input for the business, they will have to compare the profits between the two of the options. To do this, they will need to allocate their costs using their absorption costing method. However, from what we can see, the business needs to make a careful decision based on whether the product will make a contribution towards the indirect cost. Because if it does, then it will lead to two situations, where first, the contribution will be lost, and second, the indirect cost will need to be absorbed by a different product. To conclude, contribution is a valuable tool for helping managers make informed decisions. It can measure how much the product contributes to covering fixed costs and generating profits. However, its effectiveness depends on accurate data and challenges like fluctuating variable costs and varying prices across markets can complicate its calculation. Additionally, relying solely on contribution may overlook important factors such as the long-term impact of decisions, ethical considerations, or cash flow implications. For instance, a product that seems profitable might harm the company's reputation if it involves unethical practices. Therefore, while contribution is a crucial metric, managers must consider it alongside other factors to ensure balance and sustainable business practices.
Lastly, I would like to share to you guys about how AirAsia uses contributional tool to stay profitable. AirAsia is a low-cost carrier, operates in a highly competitive airline industry where managing costs and pricing efficiently is crucial. The company relies on contribution tool to make strategic decisions regarding pricing, route selection, and cost management. So, how AirAsia uses contribution as a business management tool? Firstly, route profitability analysis. AirAsia calculates the contribution margin per flight route to determine whether a route is profitable. If a route has a low or negative contribution margin, like revenue from passengers does not sufficiently cover variable costs like fuel, landing fees, and crew wages, the airline may discontinue or adjust the route. Secondly, dynamic pricing strategy. Ticket prices are adjusted dynamically based on demand and the contribution margin perceived. AirAsia sells tickets at lower prices during off-peak seasons, but ensures that prices cover variable costs and contribute to fixed costs, like aircraft leases. Thirdly, cost efficiency and contribution optimization. AirAsia focuses on keeping variable costs low by using fuel-efficient aircraft, outsourcing non-core functions, and negotiating lower airport fees. So, this can ensure that a higher portion of revenue contributes to covering fixed costs and generate profit. So, by using contribution, it can optimize pricing for profitability, identify unprofitable routes, and take corrective action. Hence, increase revenue through strategic add-ons, and maintain a low-cost structure to remain competitive.
That's all from us. Bye!